just increased capital gains tax exposure for real estate investors in Canada. And I think that this could have some hidden consequences that they haven't really evaluated yet. I'm going to talk about that towards the end of this video, but let's first dive into how this is going to impact real estate investors, not just the housing market. As always, a more in-depth version of this video and a full exhaustive report will be available in our realist.ca premium community, as well as hundreds of hours of content just like this, as well as a stacked calendar of group coaching, masterminds, and deal workshops for real estate investors, and an online interactive community. If this is something that might interest you and you want more content like this, click the top link in the description here, and we'd love to see if you would be a good fit for that. So the Government of Canada website proposes this new tax that comes under the heading tax fairness for every generation, and it's almost presented like a wealth tax, and it is sort of a wealth tax. The idea is that it will be tailored towards the top 0.13% of the Canadian population. Many people anticipated that we would see a wealth tax in Canada ahead of the budget. It was something that was discussed by a lot of people and it was almost leaked. But I think that it's a little bit disingenuous for them to brand it as the top 0.13%, because sort of what they're saying is that, so 0.13% is 53,000 Canadians, 54,000 Canadians roughly. So they're saying that 54,000 Canadians, only 54,000 Canadians sell an asset worth more than enough to realize a capital gain of more than $250,000 each year. So only that group of people. So it's 0.13% per year, but a capital gains event isn't really like an annual thing. So you can't really say it's the top 0.13% indefinitely. And I think that it kind of ignores probably the bigger problem, which is that there's so much pending capital gains in the market right now. And that's what I'm going to talk about today. So there's a lot of real estate investors who are holding a lot of real estate that they probably would or will eventually sell. We know we have a lot of baby boomers who own big houses, baby boomers who own investment properties. They've owned them for much longer, so they've experienced a lot of capital gain in the lifetime of that asset. And now all of a sudden, in like they have a 3 months notice that the capital gains exposure that they have is going to jump up substantially. So let's quickly look at that. So if your capital gains is $250,000, you would have paid $65,000 roughly in capital gains if you're in the highest tax bracket. So I have this spreadsheet set up with the tax bracket of 52%, just assuming, because most people, when they do realize a capital gains event, they get that gets added to their income and pushes them into the higher tax bracket. At the new rate, at $300,000, you would be paying $78,000 before and $82,000, so an increase of about 5.33%. Obviously, so you're still only paying capital gains. You're only at a 50% inclusion rate on the first $250,000. But anything above that first $250,000, you're paying the new inclusion rate, which is 66% of the capital gain gets added to your income and taxed at your marginal tax rate. So the gap between the old tax and the new tax grows as you get escalated, and that $250,000 shrinks as a percentage of the total capital gain that you have added to your income. Obviously, this is an objective to kind of balance the scales between older generations who own a lot of real estate and have had a lot more time to accrue those capital gains, and younger generations, especially first-time homebuyers, who you can see on this chart here, this chart that Nick and I posted on Instagram that went viral, shows how first-time buyers are falling as a percentage of the total purchasers, and investors and repeat homebuyers are climbing as a percentage of the total purchasers. Now, that being said, first-time homebuyers are still 54%, or sorry, just shy of 50% of the total. I'll just pull this Bank of Canada study up here. So you can see here's first-time homebuyers in the blue. They're basically 50% of the total. So they're not really hard done by any means to say that investors are killing the market when they're 19% of the total market. And investors are also necessary to create create rental housing, whether we like it or not. What I think will happen as a result of this is this sort of disincentivizes people from selling, because now the switching cost, the cost of them selling an asset, has gone up. And so after June 25th, when this tax comes into play, they're less likely to actually sell. And this is important to think about, because StatCan has presented some data where a significant portion of all residential properties in Ontario, BC, Nova Scotia, and New Brunswick, which is the only place where they have this data for, is owned by individuals or entities possessing multiple properties. So we have a lot of multi-property owners who are, this would qualify as an investment that would be subject to capital gain. Something like, so 20 and 30%, let's say, of the housing stock would be kind of qualify as an investment. and will be subject to this if the capital gain is more than $250,000. That's just on the individual side. And then I kind of walked into how that would look on a capital gains perspective. So it seems like the average ownership length of a property is like 5 to 7 years in Canada. And in the past 5 years, house prices have gone up 40%, from $450,000 give or take to $720,000. So the average capital gain would be over $250,000 for the average Canadian owner. And we know that 20% of those are likely to be people who are holding them as investments. What does this mean? This means that even if those people were to sell those properties on a very short real estate time horizon, if they only held them for 5 years, they would be subject to this change in tax. So a lot of investors are going to be impacted by this tax. The other piece is that this tax also applies to corporations. And based on CMHC data, rental ownership is dominated by individual investors and private corporations. So of that group that I just mentioned, that's those individual investors. That's 50% of all purpose-built rental ownership. 39.7% is private corporations. And corporations are 100% subject to this increased capital gains tax from 50% inclusion to 66% inclusion. So now you've just taken the other major portion of the rental ownership universe and applied this tax to them, which is your private corporations here. And they own almost 40% of all of that rental supply. Statistics Canada also found that 3/4 of non-individual owned properties are held by corporations, so 75% in Ontario. And they also applied this to housing specifically, where they said that the share of housing held by corporations and institutions for Ontario was 7.6 and British Columbia was 10%. So even if we're very generous and we take this 7.6% Ontario figure and add that to the 10% of multi-property owners who would likely realize this capital gains amount, you've just disincentivized 17.6% of the entire housing supply, resale housing supply, to sell. You've made it more expensive for them to sell. I actually have objectively not really any problem with a wealth tax. I think people who are wealthy can afford to pay tax. That's sort of the implication of this. But the reality is it doesn't necessarily fit with the government's other objectives of bringing resale housing supply into the market, which is taking a lot of that trickle down, that a lot of this older housing stock that is being hoarded by investors, that now is more likely to be hoarded by investors because their switching costs just went up substantially. So the likelihood of them wanting to exit that asset just went down substantially. And this is a challenge. Young people need affordable housing. I'm one of the few people in the real estate investment space, especially, leading the charge in this discussion. And I'm happy to do that because I'm part of this younger generation. I see a lot of my friends, family who are marginalized by the affordability woes that we're seeing in the Canadian economy right now. But the problem is this: it's made it so that as a real estate investor, you can either sell this asset, where you would now pay switching costs. So you're going to pay a realtor, you're going to pay legals, mortgage or discharge penalty if you have one. And you have to realize a capital gain of, let's say you made $1 million in capital gain. So your net capital gain after those fees that I just mentioned, let's say that cost you $75,000. You now have to pay about $275,000 to $325,000 in capital gains, depending on your personal situation and if you're in the top tax bracket. Assuming the step up is about 8% higher, which is roughly kind of in the middle of that spreadsheet that I mentioned, somewhere between that sort of 5 and 12, 16%. In the 100,000 range, whereas before you would have had to pay about $250,000 in capital gains on $1 million. So now all of a sudden, in that situation, you would net somewhere from $600,000 to $700,000, and you no longer have the asset. You no longer have the house piece of real estate that you owned before. In an alternative scenario, you can keep the asset, provided you have enough equity in the property and you can cash flow it at a debt service coverage ratio, usually above 1.25 is what banks are expecting. You can conservatively get a mortgage on that property for like a 70% loan to value, which would allow you to take $700,000 in equity out of the property, and the cash flow from the property would be paying off that mortgage. In this scenario, you would net a similar amount. You would literally be able to take, assuming you had $1 million in equity in that property, you would be able to take $600,000 to $700,000 in equity out of the property conservatively, and you would get to keep the asset, and you would have $300,000 to $400,000 in equity in it. So this is called refinancing, or you hear a lot of people doing HELOCs. HELOCs are a little bit expensive right now, so it wouldn't necessarily work very well. But you can also tax deduct the interest. If you're using that for business activity to earn income, you can actually tax deduct the interest off of that against the business income or investment income that you're earning. This is called the Smith maneuver. We're going to try and have the Smith maneuver guy on the podcast to discuss this a little bit. But this is a tax strategy that allows your mortgage payments to become tax deductible if the money is being used for investment purposes. And so I surveyed the audience to see what people would rather do, and I use very rough math here. Obviously, I do a lot of spoken stuff on the podcast, not a lot of visual stuff. And so I always just try and make it very simplified math. But it seems that the vast majority of investors would rather keep the asset than sell it given these circumstances. And so what this does is it actually encourages more and more people who own real estate to not want to sell that real estate asset and to keep it and refinance it and continue building their portfolio, or to use that capital, that refinance capital, to fund their retirement, which is one of the big reasons why people make real estate investments, rather than selling that asset and putting it back into the resale housing supply and allowing that to trickle down. So from my perspective, I think in the long term, this tax policy really has the potential to disincentivize real estate investors to sell their assets. I think it increases their incentive to continue holding their assets and to continue being long-term investors. I think it'll also just make it so that people will use corporate real estate structure less and less, because corporations are already subject to the higher capital gains tax inclusion rate of 66%, whereas an individual, you still have that step up from $250,000 and above. I posted this little screenshot here from an investor I was talking about today who said he was having all hands on deck today at a project so that he can get it listed and sold before the capital gains deadline changes on June 25th. And so this is one of the big impacts that I think could happen. I think that in the long term, I think this is going to stifle resale supply. In the short term, this could create a flood of retail supply, which I don't think a lot of people are anticipating. And if it does that, we could see a little bit of a dip in prices in the short term and potentially a really good buying opportunity over the next 2 to 3 months for real estate investors who are buying some of this supply that people are rushing out. You got to remember that all of these people are assuming they're probably going to have another 8% to 10% tax burden. And so they're probably willing to discount by somewhere between 0% and whatever the top end of their tax burden is from that new capital gains exposure. With all that being said, I do think that a lot of this could get offset by the plans in Canada's new housing plan, a lot of the new supply being created, but also a lot of these legacy investors who are now more likely to be in, let's call it a hoarding position, which I think is sort of like the critical name that a lot of people call real estate investors. Now these people are more likely to use these new government incentives to add a unit. They're introducing a $40,000 loan to add units to a property. They're introducing accelerated capital cost allowance. And I did do a deep dive in that in my most recent YouTube video, so I would encourage you to check that out. And I also interviewed the housing minister, Sean Fraser, as well as shadow housing minister, Scott Aitchison, about this. That's available on the Canadian Real Estate Investor Podcast and the Canadian Real Estate Investor Podcast YouTube channel if you want to check it out. We're also going to be running a webinar on the Canadian housing plan and real estate investment opportunities that could be presented by it. So if you're interested in that, it'll be linked in the description below as well. Thanks a lot for your time. Thanks for listening to this. I hope it brought you some value. And if you get a chance, please like, comment, and subscribe on this video. Let me know what you want me to talk about next. And hopefully we'll see you in the free community on realist.ca or in the webinar on realist.ca/webinar. Thanks a lot, and I'll see you next time.